Let's begin by taking a broader look at those numbers. And the key number, of course, that the market is focusing on, that you would have been focusing on, is the current account deficit. That deficit widening as expected to 3.3%, much less than the Reuters poll of 12 economists that was conducted last week. Any surprises there in those numbers for you? What were you expecting?
Not really. I was expecting more or less along the consensus. So it was not a big shock that they came in better. I think for me, what stands out is that the country still could comfortably finance the deficit in the current account. Although with the weakening global economy, where the trade partners could not really purchase as much of South African exports as expected or as one would hope for, that was not a surprise. Part of that was a moderation in exports. Right. However, imports rose a bit more than the exports did. The services account also deteriorated a bit further. Sure. But the widening was not as much as the market expected, as you mentioned earlier. Yeah. However, for me, the other things that we should also pay attention to is the state of the consumer, right, as reflected by the expenditure numbers. So for me, that's what was along with expectations, confirming that the economy is deteriorating and that it doesn't look like it's going to pick up any much in the second half of the year. Yeah. So in an overall reading of those numbers, when you look at that quarterly bulletin, does that change the monetary policy stance for you? No, the output gap is quite wide now. Right. So from that perspective, inflation is going to be relatively well contained, barring the exogenous factors that have pushed it up, i.e. the food prices, the oil prices, and so forth. So I don't think the bank is going to change its stance now. There's been some talk in the market of them cutting interest rates to boost the economy. Which camp are you in? For me, I prefer the bank to keep rates unchanged for longer rather than cut by 50 basis points, because the transmission mechanism is not going to change and create jobs immediately. And for me, this economy is not going to be, problems in the economy are not going to be solved by changes in interest rate. Yeah. It's structural issues that has to be looked at, and it's not only the Reserve Bank that's going to look at that. If you look as well at other numbers that are hidden, which people don't focus on, particularly the saving numbers and gross fixed capital formation, there was an improvement somewhat. Yeah. That came from general government. The private sector also improved capital formation, I mean fixed investment, yes, whichever way you want to call it. And for me, that's key, because that is investment in future. And that's what will drive future growth. That's what will drive future growth. But the question is that going to be sustainable in the long run? In the private sector, the problem is confidence, business confidence, as well as consumer confidence, of course. Confidence whether the economy is going to continue picking up. And we know that it's not going to happen for South Africa only if the rest of the world is struggling. So for me, that is the key going forward. How confident is business that they can spend and spend on fixed investment? And we did see the rate of saving by corporate South Africa increasing, which was good, because the rest of the economy didn't save. The government actually did-saved. The household sector moved, in my opinion, virtually sideways. There's nothing really to comment about a 0.1 percentage increase quarter on quarter. So still not saving, disposable income moderating along with the employment figures and so forth. So absolutely. And as you say, one of the key issues that emerged is the number on household expenditure, that number under pressure, confirming what we have seen. Now, our team at the Reserve Bank spoke to the chief economist, Monde Mnyande, and asked him about those those numbers, and he spoke about the impact on how he sees it affecting the third quarter. Let's take a look.
The stronger pace of economic growth recorded in the first quarter of the year made way for a pedestrian rate of growth in the second quarter, as real value added in the agricultural, mining, and manufacturing sector contracted notably. This loss of economic growth momentum was especially regrettable in light of the high and rising rate of unemployment in the country. On a net basis, very few jobs were created during the quarter, and the unemployment rate had increased further. The latest short-term indicators for these sectors seem to suggest that the third quarter of the year was not off to a good start.
Indeed. So the chief economist's view is that the third quarter may not have started on a sound footing. Would you concur?
I agree with him, because all the early indicators that we're seeing are not showing that there's going to be growth, at least coming from the expenditure side. Yesterday, consumer confidence numbers came out, and consumers are quite they have a very bleak outlook for the economy in the coming month, noting what's happening in the global economy, their own prospects, their own financial prospects. If you're not going to see any creation in employment, as Dr. Mnyande mentioned, that is a huge concern. Jobs are declining, no new jobs are being created. We saw a huge decline in sectors that actually are more labor intensive, like manufacturing and agriculture. And you remember, those are sectors that government mentioned in the new growth path as sectors that are going to contribute significantly to the 5 million jobs that they were hoping to create in 10 years' time.
Right.
So if you're not seeing growth there, that is a big problem. These things are seasonal, they fluctuate and move along with the business cycle, but the point we're making is that it seems to be a downward trend, irrespective of what the quarterly changes might be. And
that's the view that the point that I was going to make, that overall economic activity seems to be trending lower. And the question that has to be asked then is, what are the policy options for the central bank? Well, the policy options for me is that keep rates lower for longer. Yes, household debt is still quite high currently. And if you keep rates low for longer, you're going to make the debt servicing cost decline commensurately. People are going to be able to spend if they have confidence to spend. But you must remember, it's not only about lower interest rate that enables people to borrow. It's about whether the bank feels that they can give you money. And banks are very strict now, as we know, with the National Credit Act and so forth, in granting loans. And granting loans just for consumption expenditure as well is not a sustainable option. Absolutely, it's not going to help us. Interestingly, Mr. Mnyande also addressed that aspect of lower rates. Let's take a look at that clip.
Given the relatively low and/or accommodative interest rate environment, the pace of growth in bank loans and advances to the domestic private sector has risen moderately in the first 7 months of the year, but still remains subdued. While households incurred somewhat more debt, the increase in debt was to some extent outstripped by the increase in their disposable income, resulting in a further decline in the household debt ratio.
So given the overall picture that is emerging of slowing growth as well as a consumer whose condition is not a very good space, what are the implications for 2011 growth? Have you had to change your numbers? And also let's take a look at your numbers for 2012. Well, we changed, and I haven't changed my numbers now because the numbers just came out, but already with the GDP numbers that came out, I was expecting lower growth than we had forecasted early for 2011 and definitely going into 2012, because you have to remember growth has to come either from the supply side, and we've already established that the businesses are not investing as much as they should, so you're not going to see a lot of... They are saving, you just said. Well, they are saving marginally better. You must remember the overall saving rate for this country is much, much lower than comparable economies, either in the BRICS group or even emerging market. It's just about 16% of gross domestic product, way less than around 20–25%, which is believed to be a number where if you save about that much, you can finance your own gross fixed capital formation or investment expenditure without relying a lot on capital inflows to finance that, which we do a lot. On top of that, that is the kind of saving that will enable investment to create growth. But I was saying business did save marginally better, yes, carrying the overall saving of the country. Sure. But going forward, if you don't have employment creation, sustainable employment creation, growth in disposable income, and a consumer that is confident and can spend not via credit but on income, then sustainable growth is not possible. Tendani, I hope you watch one of our shows called Hot Stocks. In that show, what we do is we take apart the companies and look at the valuations, we look at the fundamentals, and then at the end of the day, we ask the question, hot or not? For South Africa, for you, the economy, hot or not?
Certainly hotter than Europe.